Good morning and good evening, everyone, depending on where you're joining us in the world. And thank you for joining us for our joint CME Group and Fastmarkets webinar. The focus of today's webinar is the launch of the CME Group's new Spodumene futures contract. My name is Molly Wardman, and I'm the Market Development Manager here at Fastmarkets. And today I'll be joined by Sachin Patel, Executive Director of Metals at the CME Group, Zihao Li, our Senior Price Reporter at Fastmarkets, and Chandler Wu, Senior Battery Raw Materials Analyst at Fastmarkets. As you can see, we have a very busy agenda today, and we'll cover the following items. We'll go through a bit of an introduction and an overview of the spodumene space. We'll also have an introduction to Fastmarkets spodumene pricing. We'll have a quick look at the 2025 outlook for spodumene. We will then have a CME Group update for the battery metals contracts that they're hosting. And then we will also have time for some Q&A at the end of the session. So please do get your questions in the Q&A function at the bottom of your Zoom screen, and we'll be sure to address as many of those as we can towards the end of the session. As a brief overview of Fastmarkets, we're a leading cross-commodity price reporting agency in the metals and mining, new generation energy, agriculture and forest products markets. And Fastmarkets price data, forecast and market analysis gives customers a strategic advantage in complex, volatile and often opaque markets. You can see from this slide that we're covering over 6,500 different commodity prices, and we're based in various locations around the world. I think it would be an appropriate place to begin this presentation with a quick look at what spodumene is and how it fits into the battery raw materials supply chain. So spodumene is a key feedstock, of course, in the production of lithium salts, which are, of course, a crucial component in lithium-ion batteries. Due to it being a key feedstock, the price can be viewed as an indicator of the overall health of the lithium market, and it directly affects the overall prices of battery-grade lithium hydroxide and lithium carbonate. In recent years, production of spodumene has increased significantly, including the emergence of new regions of production, and we expect this to continue while demand for lithium also increases. Increasing demand of things like electric vehicles and energy storage systems, consumer electronics and other emerging technologies make the price of spodumene even more significant in this space. Monitoring these prices can provide insight into supply and demand imbalances, production trends, and market competitiveness. We've seen a notable growth in liquidity in the spodumene market against a backdrop of evolution in the wider lithium markets. Although spodumene and lithium salts prices remain correlated, they've been disconnecting from one another more frequently. These developments have warranted a separate futures contract for spodumene to allow market participants to better manage their risk. And the spot trades feed into Fastmarkets prices, which are also being utilised in physical contracts, which guarantees futures convergence to the spot price at expiry. This slide here shows the number of observations collected for spodumene by quarter over the last 5 or so years. And these observations that you can see are made up of bids, offers, deals, assessments, and so on. My colleague Zihao will talk to these classifications a little later in the presentation. But by looking at this data, you can see that the number of observations are growing. Now, there's a small note here that you might see that the Q4 2024 is slightly lower than the Q3. That's due to the data being pulled at the beginning of December. So Q4 is not over yet. And we would expect these observations to meet those of Q3 or even surpass that level by the time we reach the end of Q4. We've also noted the number of contributors and the deals reported are also increasing in line with these observations. So who should be interested in this new contract? It'll be important for a range of market participants, whether that's producers, refiners, traders, banks, brokers, or battery manufacturers. And each of these groups plays a distinct role in the market in the liquidity, the risk management, and price discovery. In volatile markets, market participants must ensure they're protected against potentially adverse price fluctuations, and they can do this by implementing risk management strategies. The contract will give participants the ability to hedge this risk and prioritize stable cash flows. Market participants will be able to utilize the futures contract to manage their spodumene risk by making a like-for-like hedge on the futures exchange, and this has not historically been possible. The new launch will also help to build liquidity and transparency both in the spodumene but also in the wider lithium markets. Some participants may also take advantage of trading the spread between the lithium hydroxide and spodumene futures contracts, further adding liquidity to the contracts in the BRM suite listed on the CME. The futures contract should also help to attract project finance. With it increasing transparency across the forward curve, it will allow financing parties to better calculate the risk that's associated with financing such projects. This slide is just a quick look at the other BRM futures contracts that are listed on the CME with Fastmarkets as the underlying. And as you can see here, they cover both lithium and cobalt. And Fastmarkets continues to lead the way in this space, being the only PRA globally to set the foundation for futures and options markets in the battery raw materials supply chain. Sachin will cover some of these contracts in a bit more detail later in the presentation, but I'll now hand over to my colleague Zihao, who will take you through Fastmarkets spodumene pricing.
Yeah. Good morning and afternoon, everyone. I'm Zihao Li, senior price reporter at Fastmarkets. Now, I'd like to introduce to you the pricing methodology of our spodumene assessment, which underpins CME's spodumene contract. So first, our pricing methodology aligns with the core IOSCO principles, and we complete external audits for our key benchmarks, including spodumene on an annual basis. We are independent of the markets we serve, and our pricing process are impartial, market reflective, and market aligned. Yeah. Next slide, please. So when it comes to the pricing process, the first step is to collect data, as our price assessments are based on the data provided by the market participants. So the reporters source data from participants active in the physical market, including producers and consumers, as well as traders and intermediaries. Data collected may include deals, bids, offers, or indications of tradable levels. So therefore, I'd like to encourage anyone who are active in the spot trading market to be a part of our data reporting process. Yeah. After the data is collected by the reporters, all data will be entered into Fastmarkets' secure system called MIND, which is fully auditable for both internally and externally. Sorry, previous slide, please. Yeah, thanks. Then afterwards, it comes to the interpretation step. The data is then evaluated based on its confidence and significance level, while off-spec or unreflective data will be discarded. Afterwards, the price will be set with a rationale provided, then peer-reviewed and approved by 2 further team members before it gets published, which is in line with IOSCO principles. Yeah, next slide, please. So when it comes to the interpretation step, the published assessment is aimed to reflect the prevailing level at which a commodity of stated specification has or could be expected to have transacted in the open and competitive market during the pricing session. Like I said, we are looking at the confidence and significance level of the data points. The confidence level or the trustworthiness of the data points for deals, bids, and offers are based on their transparency, whether they are first or second-hand information, the market corroboration, and levels of details provided. While the confidence of indications are determined by the justification, submitters' visibility and active level in the market, and their prior reliability. While the significance of data points is determined based on its effectiveness in identifying the tradable level, transactions are usually considered the highest significance, followed by tight bids and offers, and then the indications of tradable levels. Some more speculative bids and offers would typically be of the lowest significance. But in certain circumstances, firm bids higher than deals or offers lower than deals could be considered high significance if they are deemed to demonstrate a clear directional change in the market floor or ceiling. Next slide, please. Yeah. And to aid the transparency of Fastmarkets spodumene assessment, we also publish the trade log and the rationale of the price. The trade log in the left picture, they detail the pricing data and volume received from the data contributors during the pricing session, while the rationale explains the assessment, describing why a particular range was determined based on the market information, and explain, for instance, why certain data has been excluded from the final range we publish. Yeah. Next slide, please. Now, please look at the specification of Fastmarkets spodumene assessment. We assess the spot price of spodumene with the acceptable lithium oxide in the range of 5.0 to 6.1%. If it can be normalized to be priced on a 6% basis, while we also limit the iron and water content, the minimum accepted volume for the spodumene price assessment is 3,000 tons, with a delivery window within 90 days. Yeah. We also continuously develop and review this methodology in consultation with the participants, hope to ensure that we adopt the specification representative of the typical trading terms in the industry. Yeah. Next slide, please. As mentioned, Fastmarkets spodumene assessments are based on the data points we collect from the participants, and the auctions for spodumene, which are represented by the green dots, they have become more common, and they provide extra transparency to the pricing. Those auctions, when normalized where necessary, will feed into Fastmarkets price assessment along with other active data in the physical spot market. Yeah. Next slide, please. Now let's look at the lithium carbonate price and the spodumene price. The carbonate price in the yellow line and the spodumene price in the purple lines. We can see they are greatly correlated, as we notice the pricing of spodumene are increasingly linked to the downstream lithium price. So in January and February, we see the prices were relatively stable for both carbonate and spodumene. That's because the market was slow when when China celebrates its New Year festival, and the lithium producers usually put their facility on care and maintenance. Then entering March and April, due to the environmental inspection in Jiangxi province, the restocking of China's battery supply chain after the Chinese New Year, the price of lithium is increased. That also sent support to the spodumene prices. Entering May, the impact from Jiangxi's environmental inspection start to retreat, while the production in China's Qinghai province also picked up, while consumers most top-up inventory hand-to-mouth. Lithium prices were stable or showed some slight weakness, putting some downward pressure on spodumene price. During the January and August period, the supply chain, the cathode makers had been destocking, so the prices were on constant decline, for adding downward pressure to the spodumene prices. but spodumene price did not fall fully in sync with the carbonate's decline, leading to thin margins among the Chinese lithium producers. And then in September and October, we saw there's some slight increase in spodumene and carbonate price. That's because of China's stimulus policies and certain lithium producers, they cut production. And from November to now, we see the demand for lithium from the downstream battery makers improved, keeping lithium and spodumene prices on an overall uptrend. But in the meantime, the spodumene sellers kept their price firm, leading to difficulty for deals to be concluded between the seller and buyer. And I would then like to hand over the stage to my colleague Chandler Wu, who will introduce the spodumene market outlook.
All right. Thanks, Zihao, and thanks for everyone's attending. I'm Chandler, and a senior battery raw material analyst in the Fastmarket. With the new spodumene contract launched by the CME and based on the Fastmarket price assessment from the research aspects, it's my honor to share my opinion about the spot market in short-term outlook. And yeah, as you can see from the picture, that we always call the history as a mirror. And from 2015 to now, that we have witnessed 2 rounds of the cycle and 4 periods of the spodumene price. The black ones stand for the increase period, and the blue ones stand for the decreasing cycle. From the October 2015 to August 2018, new energy vehicle demand increased with strong subsidies in China in 2017. Periodic high price increased the mining and exploration activities. The price ranges around 300 to 900 US dollar per ton. It lasts for 34 months. And then August 2018 to November 2020, and the supply surge from the increased mining and the exploration activities. Many productions come into the line, like Mount Catherine and Mount Mario in 2017, Pilbara, Chura, Bohel in 2018. What worse is that the EV subsidies fading away during the same period in China lead to the sluggish sales in the market. As far as I can remember, it's -1% in 2019 in China. Then the Bohel and Arturo meets the cash flow problems and the Catalin Pilbara production. It is the darkest period in the history. Then we move to the November 2020 to November 2022. With the maturity of the battery technology and the supply cut and the global EV market recovered, the spodumene price reached more than 8,000 US dollar per ton from 300 US dollar per ton in the last 24 months. And from the November 2022 to now, price slapped by 90%. This has already lasted for around 22 months so far. And I think that in this point that we have to research on the same and difference in 2024 comparing to the 2018 to 2020. Next, please. Next, please. Okay, thank you. In the left, that we observe the supply chain in China from left to right in the spot. It's the spodumene import, source production, chem production, battery production, and EV production and EV retail. It is also the direction of the supply chain. We found that in the 2022, the growth rate of the other sections are higher than the spodumene import. Spodumene could not meet the demand of the downstream, while in 2023, the growth rate is higher for the spodumene and lower for the other sections comparing to the 2022. This has caused the reversed mismatch. And in the 2024, that we found that the supply gradually compromised to the slow demand and the mismatch transferring to new equilibrium. Next, please. Then I want to observe our position in from 3 different cycles. First is the capacity cycle. as you can see from the left, we choose the Pilbara mineral resources, core lithium, sigma, and Siona as an example, and we found that we did see the capex slow down from Q4 of 2023 before the production peaks in the left bar chart, and the year-on-year growth has dropped into a negative growth rate. And this means that some of the hard rock assets will be squeezed out of the supply curve by a slow demand, expansion of the Brent assets, and the LC premium to the LHM, which is that, namely, it's LFP preferred consumption. And also that in the right-hand side that we can see that except the green bushes, other measures began to cut the capex in 2025. Like the mineral resources cut capex by more than 40%, Pilbara cut about 24%, Catalin nearly stopped the investing and will enter care and maintenance in the first half year of 2025, and even the Lighton cut capex for 2025. So all these will lead to a lower production growth rate in 2025. Next, please. Then the second cycle, I call it the kitchen cycle, which is also the inventory cycle. In left, that we found 4 types of behaviors with different combination of the price and the inventory level. And the active restocking, the first quadrant, this means that preparing more and for the strong expectation. It increased with the increased price, they increased the inventory. Then we have the passive restocking, which is the fourth quadrant, which means the insufficient demand to meet the raw material import, which means that decrease the price and increase the inventory. Then we enter the active destocking, which is in the third quadrant, which is that impairment concern to avoid the high inventory level, which is the decrease the price and increase the inventory. Then we move to the passive destocking, which is second quadrant, which is insufficient supply to meet the demand, which is that increased price and decreased inventory. We could observe that in the restocking period, that potential supply increase, but in the destocking period, the potential demand increase. Then we link to the right. This is the downstream inventory from 2020. We back engineer all the products into LCE equivalents, and we found that overall the inventory is easy to accumulate in the green market, as the working capital requirements from the newcomers and the large basis from the demand. But it is more sensible to observe the inventory to supply ratio. Sorry. And as you can see that we found 4 periods from the 2022. First is that when the price was increased from 2020 to 2022, the inventory was piling up because of the insufficient supply and the high expectation for the price. Everyone wants to keep the commodities in the hand. This is active restocking. Then the price crashed so quickly in the first 4 months of 2023 that not enough time to adjust the purchasing strategy lead to the accumulated inventory. Market turned into the passive restocking. And then from the April 2023 to May 2024, they always keep low inventory in the hand, JIT strategy used, and this lead to the active destocking. And from the May 2024 to October, supply released and passive restocking again. But more close to the end users means that more feeling for the demand. So normally that action take from the downstream to the upstream. Now, as we can see that the majority of the inventory is accumulating in the sorts. So we think that the passive destocking will happen in 2025. Next, please. Then let's see the third cycle, which is that profit cycle. We need to observe how peers perform. In the left, that we model profit margin for different process of the LCE production, including spodumene, recycling, and the lepidolite, because the brine assets is normally the lowest part in the cost curve. So we did not put it here. We found that no integrated producers from the LCE still have the profits in this scenario. Why? The LCE producers from the lepidolite, recycling have met the loss from Q1 of this year. This makes sense because that the lepidolite and the recycler as a price protector, setting the marginal producers in the cost curve. Also, this enhanced by part of the feed to the RHM production shift to the LC production due to the consistent premium from the LC to the RHM. Then let's link to the right-hand side, which is that production cut followed with the deficit. As of October, LC from the lepidolite decreased by 11% year-on-year. LC production from the recycling decreased by 32% year-on-year. With some of the production effects in the Australia, Catalin, core lithium, and part of the Pilbara, Bald Hill, we think that spodumene price will outperform the LC price in short and medium term before the no integrated producers from the spodumene go into the deficit again. Next, please. Yeah, this is our focus, but before focus, we have to think that we are facing with the lower speed of the demand and supply, need to adjust to it, like 2018 to 2020. Different is that EV penetration is lower in last round, but relatively high in 2025. This means that increasing tremendously seems impossible, except a new dominant application area founded in a lithium battery. Another is that we might get feeling that more and more consolidations happens. The past were like Galax to Alcom to Arcadium to Rio Tinto. Companies become bigger and bigger, and their ability to resist low price risk. The delay of the closure and the restart quicker than last round will both increase the exposure to the left tail risk. So there will be some production cut from the core, from the Catalin, from the Bald Hill in 2025 compared to 2024, but it is offset by Chinese assets expansion like Lijiago, like Dahongliu, as well as the Australia assets like Kathleen Valley and Mountain Holland. So the replacement on the supply curve keep happening. So, but we think that the price will broaden out from 2025, and the average price for the Q1 of 2025 is $830 per ton. So that's all for me, and I have to hand over the mic to Sachin from the CME. Thank you.
Okay, thank you, Chandler and Zihao and Molly. Hey, Molly, well done. You got the pronunciation of my name correct. There aren't many people that get that right. Even my wife messes it up. So yeah, Sachin, I was very impressed with that. Awesome presentations from before. I think some of those price charts give the clearest explanation as to CME's motivation for launching futures on this suite of lithium linked products. The volatility in the past few years has just been exceptional, and couldn't really think of a better use case for highlighting the need for risk management. So that's what I'm here to talk about. If you could move on to the first slide, please. Okay, disclaimer, this is important. Obviously, we're not going to read it, but nothing that I say today should be construed as any form of trading advice. CME's place in the market as an exchange operator, so we do not give trading advice or forecasting or anything like that, but fortunately the forecasting part has already been taken care of. Next slide, please. Okay, this is where we are today. This is specifically lithium. So some of the previous slides did highlight that CME are also working with Fastmarkets on the cobalt space. In lithium in particular, lithium hydroxide in the middle of this slide is what I would deem our flagship contract. It's the one that in the lithium suite that we launched first. I believe it was May 2021. And it has been the central point of liquidity in the lithium futures market, in the international lithium futures market since we launched it. So the average daily volumes so far this year are about 368 tons a day. The closer average in the last few months is actually up around about 500. So the market has continued to grow, and we're at about 33,000 tons of open interest. We do also have options on lithium hydroxide. They trade sporadically, but a market that I think we see great growth for going forward as the futures grow. Lithium carbonate followed. So that was listed in July 2023. It's picked up a little bit, actually, in the last few months. It took a while to get going. I think while the markets were so volatile and in free fall over much of the last 18 months, a lot of the focus was into the hydroxide contract. But a little bit of OI has built, and we're at about 614 tons on carbonate. And then finally, spodumene, which is the focus really for today. Very new launch. That was just from a few weeks ago. We had a encouraging enough opening day or opening week. We had 39 lots or 390 tons of spodumene that traded in the first week. That is, again, may not sound like a big number, but it actually got moving so far quicker than either lithium hydroxide or lithium carbonate. So we were pretty pleased to see that kind of level of traction from, I believe it was 5 or 6 different clients in the first week. And we definitely think that this completes, certainly for now, a set of our lithium suite and a very important hedging tool in its own right. So next slide, please. I'm going to just spend a little bit of time on lithium hydroxide before getting into spodumene and some hypothetical hedging examples, just purely because lithium hydroxide is our largest market in the suite. And I think it illustrates very nicely the pace that these markets can grow. So this chart just shows average daily volumes, which is on the left-hand side, the bars, and then average open interest, which is the light blue line, and reading it from the right-hand side. So as I mentioned, we've managed to get ourselves up to trading in excess of 500 tons every day in a couple of months of this year. I hope the trajectory is clear enough that both the volumes and the open interest have grown well and have actually grown pretty quickly. So if I take the open interest part now, this market has gone from essentially 0 OI at the beginning of 23 to 33,000 tons. So let's call it $400 million of notional value as open interest in under 2 years. That is an extremely fast rate of growth. We do have a lot of experience in listing these financially settled contracts using PRA indexes, and really lithium hydroxide has grown, and I would say the same with cobalt metal as well, which I don't have here. They have grown extremely quickly compared to some of the other products that we've launched historically, and for a market which is still so small in terms of its underlying physical market size, I think the rate that the futures have managed to grow and contribute to liquidity is extremely impressive. Next slide, please. This is the number of participants trading in the market. So this volume is not being contributed by just 1 or 2 or 10 different accounts. We have had in our best month by this measure over 100 different accounts trade lithium hydroxide futures. Maybe a closer average over the last few months has been around 80 or 90 different clients. So again, a very impressive number for a market which is still in its early growing phase. Next slide, please. Right, who is holding open interest? So this is, first of all, we're all very pleased that the lithium hydroxide futures at CME have managed to get onto the commitment of traders report at such an early stage. Liquidity thresholds need to be achieved for the commitment of traders report to actually be produced, and we got there actually several months ago for lithium hydroxide. So this shows by client sector, not who is trading it day in, day out, but it's a good enough guide because it does show who is holding the open interest. I like to think that this shows some pretty decent balance to our market. So producer, Slightly misleading name. The producer segment essentially means corporate clients, so customers that have some form of underlying physical exposure to the commodity contract that this chart is representing. So basically the physical market. Then swap dealer is banks. The banks have been in our market from a very, very early stage, actually, and are typically hedging on behalf of their own OTC flow, which, as it happens in the lithium market, has largely come from the consumer side. Managed money, this is interesting. Managed money is the investor world. So hedge funds and asset managers, basically entities that are managing external capital, would come into the managed money segment. 12.7%. Not a bad level of contribution, again, for a market which is so nascent still at this stage, even given that growth rate. The investor segment has been in this product actually from a very early stage. We have, I believe it's 4 or 5 ETFs that are listed in the US that have some form of exposure to CME lithium contracts or CME cobalt contracts. We have hedge funds taking speculative views. And, this managed money segment is not something that should scare anyone away from a market. Actually, the hallmark of really all of CME's biggest markets, whether it's interest rates, whether it's gold, whether it's copper, whether it's crude oil, is an extremely healthy balance between hedgers and speculators. So managed money already in a contract, which is very impressive given its comparative low level of liquidity compared to some of these big benchmarks that have been around for 50 plus years. And then finally, this other section, basically customers that don't fall into the category of the other few types. So we have other reportable. My gut feel is that other reportable here, which is quite a big part of our market, would on some definitions maybe fall into either the producer or the managed money segment, but these are clients that their own brokers have classified basically as not being in any of these other segments. Okay, next slide. I think we can get onto the spodumene side of things. Okay, so let's just maybe can you skip forward 2 slides? Let's just look at spodumene. Here is the key details of the contract spec for COMEX spodumene CIF China futures. For all of these lithium products, lithium hydroxide, carbonate, and now spodumene, the key feature is that they're financially settled. So there's no delivery, there's no physical delivery at all attributable to this to these contracts. So there's no risk in that sense. Cash settled contracts are pretty much always an easier thing for the exchange to do, especially in markets which are a small underlying physical size. And we don't need to worry about warehousing logistics, and that adds extra costs. So of course, the Fastmarkets price, the spodumene minimum 6%. Index is the underlying price that we use for these spodumene futures. One contract of spodumene futures has a notional size of 10 metric tons. We, of course, follow the pricing convention of the underlying index. And the way that this settles is at the end of the contract month, we basically look at the average of all of the Fastmarkets index prints in that month. So all of the business days that of the underlying index, we will have a look at the average of that in a calendar month, and that will be the settlement price of the futures contract. So if the average of all the prints in December of the Fastmarkets index were $850 per ton, our futures contract would cash settle at exactly that price. So if you bought it at a lower price than the settlement price, you make that as profit, the difference between the settlement price and the price that you bought it, and vice versa. If the index was lower, that would be a financial loss. So we can move on to the next slide, and just a couple of very hypothetical, and well, this one certainly I think a fairly basic example, and then the next slide will be something with a few more moving parts. So spodumene futures. This is an example of a miner's hedge. So just hedging their production, hedging their output. So what does a mining company need to hedge against? If a miner has physical sales in the physical market, which are linked to the underlying index price, Of course, the risk that a mining company would run is that that index price decreases. And then obviously they would be realizing a lower sales price for their production. So the hedge in the futures world would be to sell futures. Selling futures will help offset moves against the miner in the physical sense. So if you were short a futures contract, you essentially get profit if the underlying reference price of that futures falls relative to where you sold it. So the idea of a hedge, in this somewhat basic example, and then the next example, which is conversion margin, the idea of hedging is to remove uncertainty from your cash flows. Mining companies have, or conversion chemical converters, or whoever it is, have a lot of other things to think about. They have their core businesses to think about, and the idea of using the futures market is to remove a degree of uncertainty from output sales prices, from input costs. So that's what we're trying to show here. So let's take this example and just go through it step by step. This miner has agreed to sell 5,000 tons of spodumene at the end of March, and the price that they will sell this at is going to be the average of the Fastmarkets index in the month of March itself. So if you remember from a few slides ago, the underlying contract size for these spodumene futures on CME is 10 tons. So how does a miner hedge their full production? And again, this is not necessary. There may be a hedging ratio where you only hedge half, but we're going to assume that the full cargo is hedged. So 500 lots, which is equivalent of 5,000 tons of these March futures, would be sold, and we're just going to guess that or assume that the current market price of these March 25 futures is $805 per metric ton. And we're going to assume that the miner is already above their cost of production, which we've assumed to be $700 per metric ton. So fast forward to the end of March. The end of March is the end of the physical pricing period, and it's also the end of this derivative hedge. And what has happened? We've seen actually that the Fastmarkets index averaged $755 per metric ton. So in the case that the miner had decided to do nothing, you have still sold above your break-even cost of production, 755 versus 700. So in some sense, you're still pleased, and there would be a profit on your physical sale. However, the idea here with the futures leg is that you've actually been able to lock in the level that you sold the futures contract at. Okay, so even though your cost of production is 700, you've sold these futures contracts at 805, and now we've subsequently had a settlement at 755. So if you take the futures leg here, today I've sold 500 lots of March 25 at $805 per ton, and at the end of the pricing period, the futures contract has cash settled at that average during March, so $755 per metric ton. So I have a profit. I have a profit between my entry price and the average, which is $50 per metric ton. That has essentially been a buffer on top of what my break even or above the average of what the average of March above the break even price was. So my total P&L, if you want to think of it as such, is going to be the physical sale realizing above my cost of production, so $55 per metric ton. But it also now includes this extra $50 that I've made from my futures hedge. So a total P&L of $105 a metric ton, or put maybe a different way, I've managed to realize a all-in sales price of $805 per metric ton instead of $755 per metric ton. So that is a level that I entered the futures hedge at. Of course, this can go the other way. There would be a case that the market rallied and I made a loss. So I'm happier from the physical perspective, but I've made an offsetting loss on the futures side of things. But the net result would still be the same. I would essentially be realizing a sales price of $805 per metric ton. So this can go both ways. And again, the idea of the hedge is that it's supposed to be giving you a level of certainty in terms of your margins. So can we move to the next slide, please? We'll round up with the combined hedge for a chemical converter that has both spodumene and lithium hydroxide exposure. They're not an integrated company, so they have risk in terms of purchasing spodumene, and they have risk in terms of selling lithium hydroxide. So for this example, we've assumed an 8-to-1 conversion between spodumene and lithium hydroxide. Again, we'll use, and this has a few more layers of complexity. So one layer of complexity is you've got two commodities to think about. You've got an input and an output. The second level of complexity is you've actually got essentially different pricing periods. You're going to be purchasing spodumene basis the average in March, and then you will actually be selling your chemicals basis the average of April. So what would the hedge here be? You've agreed to purchase 4,000 tons of spod on the March average. So your hedge could be to buy 400 lots of the CME spod futures. And let's say that that's at $805 per metric ton. We've assumed a conversion cost here. I hope that's somewhat accurate. The minus conversion cost is $3,000 per metric ton. And then ultimately, the refiner has agreed to sell 500 tons of chemical at an average of the April index from Fastmarkets. So how do you hedge against that? You would be selling 500 lots of April lithium hydroxide futures. So we've made some assumptions about your entry levels here. You've purchased futures on spodumene at $805, and you've sold futures on lithium hydroxide at $11 per kilogram. We've made some assumptions further on that at the end of March, the spodumene average price was actually now at $905 per metric ton, and at the end of April, the lithium average price was at $11.5 per kilo. So actually here we've assumed that that conversion margin has compressed somewhat. Now we've got a similar layout on the right-hand side here, a few different boxes showing different profits and losses from various things that you've done. So on the spodumene side of things, you have to purchase your spodumene at $905, but you've got a futures profit of $100 per metric ton. So what does that mean? It really means that your all-in price for purchasing the spodumene ultimately ends up being as $805 per metric ton, the exact price that you entered your futures hedge. If you move to the lithium, you've made your sale at $11,500 per metric ton. And again, remember, you're short the lithium futures. You have sold them, and that would mean that you've actually had a loss on the lithium side. So again, what does that net out to? You've got a sales price of $11.5 per kilo, but you've got this negative 50 cents per kilo loss on the future side. So the net result is you actually got an all-in sales price exactly where you sold your lithium futures at $11 per kilogram. Okay, so you can sort of tinker around with these numbers. You know, we've tried to keep it somewhat realistic with markets moving in the same direction, but just making an assumption on whether that margin compresses or expands. And the end result is going to be the same in that the same analysis without the hedge is going to have a lot more volatility in terms of underlying cash flows compared to if you actually locked in prices using the futures market. So that is our example number 2, a few sort of stages on from the simple minus hedge on the previous slide. I believe that's it. Is there a following slide? Okay, there we go. So that is the CME section done. Some examples of how to use the market to hedge, and also an overview of how things have been going in our lithium suite in general. So markets that we are really constructive on, they are going to remain a core focus for us. I think the opportunity over the next, several years in lithium derivatives is going to potentially be a huge one. We all hope that this is the next iron ore, and I'll pass that back now to Molly and the team, and it looks like several questions have come through. So thanks for listening, everyone.
Perfect. I've just put up a slide here of everyone's contact details, just in case anybody wants to get in touch with anyone after the presentation. But if we move now to our Q&A segment, we still have a few minutes to answer some of your questions. And I can see that a few are coming in as we speak. If I perhaps take the first one, I think to Zihao, do Fastmarkets consider the long-term contract prices when assessing spodumene?
Yeah, hello everyone. So Fastmarkets, for the price, whose specification I just showed now, the MBLI 0012. It's a spot price which CME spodumene contract is cash settled against. So for that specific price, we reflect the tradable level of spodumene negotiated on a fixed outright price basis with a delivery window on the 90 days. And we do have a separate price assessment for the offtake or the long-term contract spodumene prices, which is published on a monthly basis. And our spot spodumene and contract spodumene prices are assessed independently and not impacting each other. Yeah.
Perfect. And I think, Chandler, I think this one is probably best positioned for yourself. Someone is asking how we gain transparency on inventories by type. So into, salts, CAM, things like that. Where do we kind of manage to get some of that information from?
All right. Yeah, actually that we update our top-down models that checks the implied inventory in the LC equivalents from the source production through to the EV dealerships to illustrate the dynamics of each node of the supply chain. It's balanced derived. So namely that it is inventory equal to the production minus sales minus net export is the basic approach to track the implied inventory level. And the inventory divided by the supply ratio acts as an indicator of the inventory level in the supply chain by taking the working capital from the new market participants and increasing, decreasing supply into considerations. And if you feel this is interesting, then feel free to refer to our short-term forecast and this kind of inventory update on a monthly basis. Thank you.
Great. And Sachin, perhaps this question for you. What is the open interest currently for the spodumene concentrate futures contract?
It's 39 contracts. So everything that we had that traded on day one or week one, which was 39 lots, was for December maturity, and we haven't seen any of that unwound yet. So we're at 39, and really that positioning, once December is priced out, will then roll off.
Great, thank you. Sorry, just going through the list here.
I went ahead and answered one, Molly, but I'm happy just to go quickly. One attendee had asked what's ADV and ADOI, so apologies, CME, we use a lot of acronyms. ADV is average daily volume, and ADOI is average daily open interest, and we look at both of those measures in terms of number of contracts, not like number of tons or number of kilos or anything like that. So yeah, that's what those two acronyms mean.
Great.
And hold on. Yeah, and I saw that someone asked how many mining projects have come up in the past 5 years, and are they enough to meet demand? Let me take this, because that's the mining products are coming from the capex import in the blooming market. In majority, it's in the 2020 to 2022. So whether it could meet demand, maybe that it depends on the time horizon, I would say so, because that it's, from my opinion, is that it could meet the demand for short term, right? But couldn't meet demand for long term. This is my opinion. And in the past 5 years, if you can remember that, especially from the Africa, that the LC supply from 0% to 7% as of the total LCE supply, like Sabi Star, Kama TV, Bikita, Acadia, they start out the production in this period, all right. And the other greens like Sigma, Lightom, and the browns like expansion of the Mountain Mario and the Pilbara, etc. So a lot of products that just come into the line. And what is more concerns in the short term is that we think that issue is the more important issue that which will press the price is that the restart of the mine is not that complicated for the lithium. If we still remember, we trace back, I mean, the Ganju restart approved in the June of 2021, and the first concentrates out in the October 2021, so 4 months. And Wodgina approved in October 2021, and the first concentrates out in May of 2022. So namely, it's 6 months or 7 months. So it's really quick, not like 2 years, 1 to 2 years, not that long. So this will press the price in the short term, medium term. Yeah, thank you.
Thanks, Chandler. I think, Sachin, another question for you. Someone's asking, what does open interest mean?
Yeah, sure. That is the number of outstanding open positions that are held in a market. So it's a gauge of really how many contracts or how many tons the market currently has exposure to. For example, let's say that we launch a brand new contract which starts trading right now, and I buy Molly is on the offer, and I buy her offer for one contract. That would count as one contract's worth of open interest because we're both holding those positions. Now, if the following day there was some more market activity, but actually I sold the contract that I own to another trader, let's say Chandler, the open interest would actually stay at 1 because no new open positions have been added to the market. All that's happened is that the contract that I bought on the first day, I have now sold it, but I've sold it to a third counterparty. And if I had sold that contract not to a third counterparty, but actually to Molly, then the open interest goes back to 0 because all I've done is I've sold what I bought and Molly has bought what she sold, and the overall outstanding amount of open positions goes to 0. So it's a very, very important measure of liquidity. You know, volumes tells you one thing and it tells you the overall turnover in the market, but open positions, you can get a lot of volume with very little open interest, and that's just an indication of customers sort of churning the market, and you know, open interest is actually a great gauge of the health of a market because it shows some level of kind of stability, and that the market is actually really being used for some kind of hedging or maybe long-term speculative purpose. So those positions are kept open.
Great, thank you. And looks like we've hit the top of the hour. So unfortunately, no more time for questions, but we will be sure to get back to everybody on their questions offline.